Okay. Hello, everybody, and welcome to this week's edition of Selfwealth Live, the technical analysis edition. We're here for another great show. It's been a lot happening, obviously, over the last few days since we last chatted. Hello, Jace. How are you today?
Hey Rog, I'm good. I'm good, thank you. Looking forward to another show talking about markets, talking about the stocks. Always interesting to view stocks. So yeah, look, all pretty good here.
Yeah, exactly. What's made this week unique in another, especially compared to a lot of the other weeks, is very rarely do we sort of face weeks once again that have had bigger size drops in comparison to all the other weeks. So it's always good to just talk about this, especially as our portfolios were probably showing a bit of red last week. I know mine was anyway, Jason. I got to speak for myself, and I see a lot of other people that are saying the same things. Right, I hear a lot of people saying the same things. So it'd be good to chat about that. Welcome to everyone on the other side of the line. Hello. Hi, Jen. Sorry, I'm not sure. You says live chat not working, but I see you put that comment in. So it is working now. So g'day, put your comment in now if you can. Don't forget, if you are a new member, a new viewer of this show, what we do is we go through the Australian market, the US market, and the Hong Kong market from a technical analysis perspective, from a price charts perspective. And we talk about market structure and how that's currently looking, and maybe positioning itself. And then what we do is, if you've got any general questions, pop them in the chat. For us, we will get onto that. I certainly have a general question for Jason today, so if we've got nothing else from anyone else, hopefully my question will help answer a lot of others, if you haven't come across this in the past. So I'll have a question for Jace later on. And then, of course, your tickers. Put your tickers in the show. We're going to have a look at that from a technical analysis perspective as well. We'll aim to get to one ticker from everyone. And if we do have time, obviously, we'll circle back. So, but other than that, Jace, looking forward to another great show. Let's have a look at the disclaimer, please.
Okay, so just quickly, everything we do today is going to be general commentary only, no personal advice in anything we do. And to quickly pop up our disclaimer that we do each week, I'm also not part of the Selfwealth SIFE team. My business is Motion Trader. You'll see my details up the top, licensing, general commentary, all of that. And beneath there's a Selfwealth disclaimer. Goes through the same thing, licensing, general commentary. Everything is on that little slide on the screen right now.
All right. Fantastic. Thanks, Jace. Okay, so let's start off with that Aussie market. It has started a rebound yesterday, but we did have a few red days at the end of last week. Hey, let's have a look what it's looking like right now.
Yeah. Okay. So over to the ASX 200 to get us started. And yeah, look, the end of last week was pretty rough. I saw it in my portfolio too. And so yeah, like when we caught up last week, we spoke about the possibility of several weeks of consolidation, and well, that's very much what last week delivered. I think the key to the near term, if we're going to have a bullish outlook near term, I think the key to that is for prices to become established above these moving averages. So if you don't know, I use the 50 and the 100-day using moving averages on these charts. So yeah, that key is becoming established above the moving averages. Friday's price action was particularly interesting because you can see prices broke below the moving averages, as well as taking out two recent lows, one from say mid-January, one from early Feb. So took out those two lows below the averages, but then we've since had a quick rebound, and prices are now back above the averages. So just a brief excursion below the averages on Friday, and it's a bit of panic in the air on Friday too. I felt with some movements in some of the stocks, but yeah, we've got that rebound now. I think the fact that we didn't get follow through selling from Friday's sell off, I think it's a sign that it was a bit of like short-lived panic rather than the start of a trend change. And I think it's what happens around these moving averages now that probably sets the tone for the next move of note. If Friday's weakness is contained, if that's it, if that's just a short bout of selling and we stay above the moving averages, then it does set up the potential for potentially a run at the all-time high from October. maybe that could happen over the next couple of months, and not something I'm suggesting is going to happen in the next couple of days. But if we can become established above the averages, that can be the springboard to a test of those highs. But what if we don't hold above these moving averages? What if prices slip? What if prices slip back below the averages, come back down, retest the Friday's low? And I think if that were to happen, that would be the sign that the market just lacks sustainable momentum pretty much in either direction. Because, like, you think back to November, prices were in a vulnerable position below the moving averages and they couldn't sell off. And if the market can't hold above the moving averages now and starts to dip back below them, well, then it's a sign that it's probably not ready to continue the upward trend from this upward trend from 2025. It's not ready to continue that either. So then that would open the possibility of maybe a range developing, like using the October high, using the November low as key points. It's possible we get a period where prices move within a range. So there's different things that could play out. We've got to see how the price action develops. As I say, can prices become established above the moving averages? That's the first thing to monitor. I think the upshot of all this is that I want to stay long stocks, but I'm a little cautious on the timing. So I do wonder, could prices dip back below these averages? And sorry, Rod, give me one moment. Something's gone amiss with all my cords there, and we're about to become unplugged.
That's okay. You
Right.
replug.
I've averted a shutdown, so we're still in action. Good.
Lucky you told me enough to maybe continue on a little bit of this, James. Just stay with me. All right, stay with me.
So there we go. So the upshot is I want to stay long stocks, a little cautious on that timing in the near term. Another factor that could favour a range developing is what's happening over in the materials index. Quick look at that. This is the ASX 200 materials index. This has had a great run over the last 6 or 7 months, but it has become stretched above those moving averages. We've seen that volatility in some of the commodities like gold and silver. If we've started to see signs of a pause in this trend. If this trend were to continue pausing, maybe trading sideways, maybe pulling back towards the moving averages, well then, like, this has been one of the big drivers of the ASX 200. And if the materials start to consolidate, well, it removes that upward driver of the ASX 200 generally. So maybe that leads into more of a pause. And then lastly, when we look at the equal weight, the ASX 200 on an equal weight basis, and this is at a really quick reversal. You can see this is where a lot of the it doesn't look so bad when you look at the ASX 200 index, but when you look at the equal weight, this is why I think a lot of portfolios felt saw quite a bit of red last week. It's like, what's happened in the ASX 200 equal weight? Small ordinaries, emerging companies also look similar to this. So that's why there was a lot of red last week. And this is quite different price action to what we've been seeing previously. We've had these strong rallies and the shallow dips. You can see it. This is what we've really been conditioned to over the last 9 months: strong rallies, shallow dips. This has been something quite different. Maybe this is I don't think this pullback puts an end to the uptrend, but I think maybe it points to the trend being on hold just for the near term, and maybe we get some more consolidation coming. And by consolidation, it doesn't necessarily mean prices continue falling, but maybe prices move within a range. I think now is a time to give. I think it's a time to give winning positions plenty of room to move around with the aim of seeing off any further consolidation, but at the same time, just being ready to sell stocks that are no longer working. If stock's not working, if it's come back, maybe it's moved into a small or moderate loss, maybe think about moving it on. And I think also probably being patient with buying for now, unless something really stands out. I don't want to just come in and buy something which is a bit marginal because, okay, it's a bit cheaper than last week, so I'll buy some. It's got to really stack up to be a buy at the moment.
Okay, all right, fantastic. One thing that I got out of a show a few weeks ago, and I really like seeing the difference, right? Because if we could we bring up the financials ASX, because we talked about that two-speed economy where the financials were dropping and the materials were increasing, and that's what was propping up the ASX. What's the financials looking like? Obviously, it's being such a big part of that ASX 200.
Yeah, it's starting to improve. So it's lost that downward momentum which was building late last year, and you can see the financials are back above their moving averages. The moving averages are tentatively started to turn higher. So it's this is a first step, getting back above the moving averages, and now it's becoming established above the moving averages. That's the next thing to look for. I don't think this is quite ready to take over from. Where the materials have been delivering that strong upward momentum to the ASX 200, doesn't look like it's ready to step in and do that in the financials just yet. But it's look, the structure's improving, but it does really need to hold above these moving averages. What I don't want to see is quickly back below the moving averages, and then that sets up the possibility of this being a sideways consolidation, then further selling comes in. It's still at a tentative sort of point, but whilst we're above the averages, it becomes impossible for more constructive price action to develop. But one to keep watching.
Fantastic. Okay, so yes, I was certainly happy to see that one price action bar on the end of Friday, on Monday morning when I opened up that chart. The other good positive sign for me was the US market seems to have reacted quite well to whatever was happening over there, and the Dow has also hit all-time highs. Let's jump onto that
Yeah,
US market.
the US is so interesting at the moment, and like there are strong parts like the Dow. We'll get to that in a moment. But then at other parts of the markets, I wonder, are there cracks appearing in the US market? So prices dipped below the January low on Thursday. You can see there's the January low. Prices dipped below there on Thursday, and then came close to the 100-day moving average. I'll come back to the S&P 500 in a moment. Talk a bit more about that then. But let's start with the NASDAQ first, because I think this is one to really pay attention to. So this has been the weakest segment of the US market for several months. We spoke about the Magnificent Seven last week, I think, and previous weeks. And tech generally has been the weakest segment of the market. While there's been strength across other sections, like the Dow, like industrials, this has been the drag. This has been the drag on the S&P 500. Looking at the latest price action, the Nasdaq broke below the January and the December lows just recently, just last week. The January December lows broke below those. It's also had consecutive closes below the 100-day moving average just in the last week, and it hasn't had consecutive closes below the 100-day moving average since back over here in April. So does this signal a trend change? And the answer to that is, well, no, it doesn't. And uptrends pause. They can dip below the moving averages, like you can see, like just in the previous during 2024. There's some dips below the moving averages, so that happens. You can have these dips below the moving averages. It's at this point, there's not enough here to say, look, this downtrend is this is not enough here at the moment to say this uptrend has changed. For that, I'd want to see the underlying structure change, like it did for instance, like it did in 2022. So prices got below the averages, rebounded, moving averages were declining. It was sell the rally. That's like the structural change. We don't have that at the moment. We've got like one of these dips below the moving averages, which often do resolve to the upside. So this isn't to say like everything is turning south in the Nasdaq, but yeah, look, it is. I think it is something to monitor. That structural change like 2022 hasn't happened yet, and but it's something to watch. The other look on the positive side, it's like I think to get particularly worried about the US, would want to see, I think, would need to see worrying signs in other indices. But at the moment, other segments of the market look strong. Like, I'll show you what I mean with the Dow. So the Dow, looking at this is a textbook uptrend. There's a long-running series of rising lows and rising highs. The moving averages are trending higher, and prices just broke out of this nice little tight consolidation along the moving averages, breaking to a new all-time high just this week. So the Dow isn't giving any warning signs of a major turning point. That's not to say top can't form, but it's not the condition we have at the moment. Then you look at the equal weight, the S&P 500 on an equal weight basis. And this is another important part of the picture. It had its highest closing level ever on Monday. And as we often talk about, all-time highs aren't a bearish signal. In fact, all-time highs tend to lead to more all-time highs. So just like the Dow, the equal weight has rising moving averages, prices above the average, and it's a similar story in the small cap. So we've got this unusual situation where participation is expanding, and you can see that through the equal weight. You can see it through the small caps. So we've got participation expanding, but you come over to the NASDAQ and it isn't performing. And I think this muddies the waters somewhat. Is it simply a case of rotation out of tech? That seems to be the popular story in the market at the moment, that we're just seeing rotation. Or is divergence between tech and the rest of the market? And is that divergence a warning sign? So people are going to have opinions one way or the other, but no one actually really knows. I don't think we should ignore this ongoing weakness in the NASDAQ. And I think there's enough here just for some near-term caution, some caution around how we might be approaching the market. Just looking at the recent volatility in commodities, in Bitcoin, if risk-off sentiment were to spread to other parts of the market like equities, well, then maybe this NASDAQ pullback could be some sort of a warning, and maybe prices could pull back. But as I say, we don't have any bearish signals yet. Just enough to say, look, it's worth keeping some caution in mind. Coming back to the S&P 500 quickly, it's look, this overall upward trend remains in place. The potential for ongoing consolidation or a pullback towards the averages, it certainly exists. I think we can be patient with buying this week. I want to see signs of the dip in tech being bought and prices getting back above their moving averages. And then, as always, having that exit strategy in mind for stocks that aren't performing. So it's an uptrend with a non-confirmation signal coming from the NASDAQ. So I think it's something to keep in mind.
All right, great analysis there. Thanks, Jace. What about the Hong Kong China market?
So going over to Hong Kong first, the Hang Seng, prices are stabilising around the moving averages following that recent reversal from January's high. As we discussed last week, I've got some concerns around the price action. So we had a nice breakout in late January, but didn't attract follow-through buying, and prices quickly came back down and are below the breakout point. So you can say the breakout point there's the breakout point, wasn't sustained, prices are back below there. And when you don't get that follow-through buying and prices quickly reverse, well, that's called a false break. So potentially got a false break there. So the trend does remain up. As shown by the moving averages and price being above the moving averages, but it's just one to watch closely. If prices continue to stabilise around the moving averages, then maybe it's just a case of more consolidation, then a sustained move higher in the weeks ahead. So bullish for now, but always a little bit of caution when I see a false break. And then over in China, Chinese stocks are now starting to rebound after briefly breaking below the November low. You can see the November low on the graph here. Rallied off there, then we've come back, broken below, making a new low. Now we're seeing the market rally. I think the bullish perspective would be that this is potentially like the final stages of a zigzag correction. That could be entirely possible. So we've had a strong rally, zigzag correction, and from there prices move on to new highs. That'd be an entirely reasonable sort of price action to look for. If that's the case, it's important for this recent low to hold and for prices to quickly get back above the moving averages. A more concerning situation would be if prices were to stall below the moving averages. That could set up a situation where we get, say, we were to get, consolidation below the moving averages. And that's a concern when we get consolidation below the moving averages, because it then opens the potential for a breakdown. That, of course, hasn't happened yet, but that's what we watch for when prices consolidate below moving averages. And below averages, of course, opens a window of vulnerability. I sold half of my Chinese exposure this week just on this rebound. It's just reducing risk a touch, just unsure about what's happening in the US market and what's happening here. And at the time I'd sold it, we hadn't had much of a rebound, so I've just halved the position. But look, I still think this can resolve to the upside. But look, the first step is getting back above those moving averages, and then from there breaking higher. And then, should that happen, I might reinstate that position I've just scaled back from. But at the moment, let's just watch. Can we get flip back above the averages quickly? I think that's the key now.
All right, fantastic. Thanks for that, Jace. All right, we've got plenty of tickets to get through, but before we do, I have one question for you, Jace, and this is around position sizing. So hopefully this may answer some of the viewer questions in future or even now. But let's put a scenario out there, Jace. Let's say you've done really well in your portfolio over the last few years, and you've stuck to this position size of 5%. We'll just use an example portfolio of, let's say, $20,000, 5% position, which is $1,000. Obviously, I'm using small numbers here. I'm sure many viewers have bigger numbers, but they can adjust for theirs. So let's say I've used a position of 5% per stock, which is about $1,000. And over the last few years, you've doubled. Let's say you've doubled the account. So from $20,000, your portfolio has gone to $40,000. You're now wanting what? How do you increase your position size at that? So at that point, do you add more stocks to the portfolio and stick to that 5%? What would be your take on this question?
Yeah, it's a great question, Roger. It's one I get quite a bit with my motion trader subscribers. Like, often I'll get someone who maybe they start with $20,000 and they build up their confidence with the process and how it all works, and then they say, "Look, I've been doing this for a year. I'm really happy with how I like trend following. I like the way the approach works. I want to bring some more capital in. I want to bring it up to 40 or 60 or whatever it may be, $1,000, or it could be someone's just done well and they're working out as your example. It's like, what do I do? And the question is, what should I do? Should I increase my position size or have a larger portfolio? And there's no one answer for everyone, and a lot will depend on the situation. So for someone who's gone from, say, a $20,000 to $40,000 portfolio, like, you think about like $1,000 trade. So we've got $20,000. We've got $1,000 per trade. We've got 20 stocks in the portfolio. I'll often suggest and this is all general. I'll generally suggest that. So $1,000 buy at we'll use Selfwealth's brokerage. Say it's $9.50 a trade. Let's just say it's $10 for simple numbers. So it's 1%. So you're paying 1% brokerage every time you buy. It's 1% brokerage. If someone's paying $20, which is like other brokers may charge, maybe it's 2%. So that's it's a significant percentage per trade for $1,000, and then you get brokerage when you sell as well. So you might have a 2 to 4% headwind just in percentage brokerage. So, like $9.50 is not much at face value, but percentage-wise, when we apply everything percentage-wise across a portfolio, it's still a meaningful number. So by doubling position size to 2,000, brokerage now becomes 0.5%. So that can be a worthwhile exercise. You get the economies of scale of increasing position size. So that's something to consider. Whereas someone else might say, look, I've got a $100,000 portfolio. I want to add an extra 100,000. It's well that example I just went through is less applicable because say they're doing $10,000 a trade, their brokerage is already 0.1%. Do they need to take it to 0.05%? It's really neither here nor there. In that case, in that situation, maybe it's a case of maybe they want to have more stocks. And I think for a trend following, like I think part of the strength of a trend following approach is having many relatively small trades. So 20 to 40, I think, is probably a good number for a lot of people. There's nothing wrong with having more than 40. Really depends what works for the individual, but yeah, increasing the number of positions is also a good consideration because we never know which setups are going to deliver the big trends. You might have two stocks, the setups might be identical. We might have stocks are consolidating above moving averages and breaking out. One stock might run for a bit and then come back. Another stock might just keep running. So if you can have a few more stocks in your portfolio, I think as well as spreading your risk more, you're also increasing the odds of getting on some of those really big trends. So that's what we do, spread risk widely. So I think increasing position size is also a good way to as well as increasing position size, increasing the number of stocks in the portfolio. But as I say, it depends on your starting point. If you've got a smaller capital base to start with, maybe the first point of call is getting that percentage of brokerage down. As you've done that, then it could be a case of increasing the number of stocks in the portfolio. And it's like looking at it from your own situation rather than like this is the way you need to do it. You need to look at your situation, then think about those two variables.
Yeah, of course, and I think that's the important thing. Obviously, we're just providing general guidance, right? So you've got to come up with a decision. And I think the thing is, obviously, we talked about this in the past that people might find, managing 40 stocks could be quite daunting, right? But ultimately, the idea is to sort of have a schedule when you do manage them and stick to it as best as possible, knowing that what we do doesn't take a lot of time to manage. But it does come back down to your lifestyle and how you do it and what you do, right? I do like the idea of increasing the number of stocks, but sometimes it is a bit daunting to me to manage, right? But I know you manage it quite well, Chase. Right?
Yeah, it's not as hard as I think a lot of people believe it might be. So I've probably got like my portfolio could be up to 80 stocks. It's currently it's on the website, the Motion Trader website. You can see all the stocks and how many and which stocks they are on the Motion Trader website. I think there's probably, let's say there's about maybe 40, 45 stocks at the moment. A couple of weeks could go by and I might do nothing. It's medium term. What I do is not short term trading. If you want to be short term, if you want to be a swing trader and be in and out of stocks every couple of weeks, 80 stocks or 40 stocks is going to be a heap of work. But if a large portion of your portfolio stays in the portfolio for over a year, yet there's not a whole lot of activity. Like I might average just roughly, say I might average 2 trades a week for a large portfolio. That's not work intensive. You get a COVID type situation where the market crashes, well, then it can get very busy because there's a lot of exits to do. But that, fortunately, crashes only come along once every, maybe it's once every 10 years. You get something really, really that makes the history books. So it's often that's not. I don't think that should be the overriding consideration. A large portfolio, like you get good we can get portfolio tracking software now where you can have your trades automatically uploaded, your dividends are automatically accounted for. You can get a tax end of year tax statement from, I think Selfwealth might do that. Those online software providers, they do that as well. Give it to the accountant. It's not like you got to have a spreadsheet with all these stocks and you got to track every dividend, and that would be onerous and that would be unworkable for most people. But with the style of trading or active investing that I talk about, which is medium term, and also couple that with the technologies that's available to help manage a portfolio, it's completely workable. So be open minded to having considering a larger portfolio. It's look, people might say, oh look, I just want to keep it simple. I just want 5 stocks, and okay, if that's what people want to do, that's okay. But then you miss that opportunity of casting that wider net, and it's really your stock selection becomes critical. If you don't get the right stocks with your 5, it's like how do it might be hard to outperform. But if you've got 20 or 30 or 40 or more stocks, I think you increase the odds of getting some of those outliers, which can really make the difference.
Yeah, well, I found that experience with my 20 to 30 portfolio that I have. And one of the things that I kind of not actually, just sorry, before I forget, just going back, you've said Selfwealth provides tax reporting. We don't necessarily provide tax reporting, just transactional reporting. So that doesn't calculate gains or losses, right? So just to be clear to viewers, right, there is software out there that does that for you, though, right? And we can feed that software to help. But going back on, I think over the years, I've probably spent around about an hour a week managing my portfolio. If I look at it, maybe 5 to 10 minutes a day, not even that. And I think this whole mindset around this industry and share trading around set and forget once again, putting your money in ETFs and set and forget, I think that's gone to another level, and I don't like it because I think it puts people in this false sense of security and going, oh, if I just put my money in there and allow it go for the next 20, 30 years, I can just set and forget and not worry about it. If you can't, I feel like if you can't afford to put about 10 to 20 minutes or even an hour per a week in you're in this business, it is a business, then it's going to be hard, right? It's going to be hard.
You've got to if I think if you want to own individual shares and you want to have your own actively managed portfolio, you've got to put in some time. If you don't want to put any time, well then ETFs are a great way for a lot of people to go. If you're not interested in the stock market or you don't have time, maybe it's ETFs. If you're interested in stocks, you've got to make some time to manage your portfolio, to set and forget. Let's buy a stock and then let's look and see where it's gone. 2 years later, if you bought the wrong stock, it could be a nasty surprise. So you've got to. I don't think we can have individual stocks that we don't look at for 12 months. You got to manage them. I think it's my view. If you don't want to manage them, look at an ETF.
Yeah, for sure. All right, there is a follow-on question. I'll just from Elisa. Let's just get onto that. If you start with 1% per trade, and the trade gains, when does it get to be too much of your portfolio where you have to scale back to reduce volatility? E.g., example 5%, 10%. Does that make sense to you?
Yeah. It as a position as a stock rises, its position and the amount of capital in that stock relative to the portfolio will probably increase. I've had a situation where a stock got to maybe about 12% of my portfolio because it's gone up 700%, and this is when I had a 40 stock portfolio. So my initial position was larger. And so I scaled it back. I don't have a specific rule where I scale it back. Everyone will be different in terms of like how they want to do it. I think the purest trend following approach is to not scale it back and just let it run, but there's going to be more portfolio volatility as a large position swings around. Nothing wrong with that. It's just one approach. I like just to take the top off some of the larger positions once they get to maybe up through 300, 400%, which might be around 5%, 6% of the portfolio. I might just bring them back a touch. But really, I think the key. I think the key is let profits run. People who take profits at they're made 10% or 20% or even 40%, and they say, "Oh, well, I'll sell half. I'll sell half at 40% and get a free trade or something." I think that makes it hard to go forward because you're always diluting your winners. Yet your losses, the way a lot of people trade, they don't sell their losing stocks. In fact, a lot of people double up. They're down 20 or 30% and they'll buy more. So we're increasing our risk with losing stocks and we're diluting our winners by scaling out too quickly. I think ideally we want to maximise our gains, let them run, but then it's okay to scale back a bit from a large profit just to reduce portfolio volatility, which a larger position will naturally cause.
All right, fantastic. And Max, how are we going? I think we sort of answered this in what we've been talking about, but he wants to know how many is too many stocks, Jace? Is 100 too many? Is 70 too many?
Well, if it gets to the point where you've bought the entire index, so then you just get market performance. So if we're looking at the ASX 200 and we have 200 stocks, well, we've basically got a homegrown ETF. So you can have too many. I think that if we're looking broadly across the market, like I look at what Motion Trader does, it scans the entire market, but it's really probably around the top 750 stocks, which will make it into the portfolio because there's a long tail. There's a long tail of 1 and 2 cent stocks which which will be filtered out. So if you got a universe of maybe 750 stocks, a 70 stock portfolio is, I think, completely reasonable. So you've got a 750 stock universe, and you're prepared to have 10% of them in your portfolio. So you're cherry picking. The aim is to cherry pick from that top 7 or 800, whatever it may be. A 70, 80 stock portfolio, 10% of the universe. That gives you the opportunity to take out the parts which are to buy the parts which are rising, ignore the big middle section which is going sideways and the bottom section which is going lower. So look, I think there's scope to have a. If you're just focusing on big cap stocks, ASX 200, well, 80 stocks is going to be almost half the index. But yeah, depends like where are you looking as well? What's your universe of stocks? You certainly can get to too many. But generally, if we're looking at a large section of the market, I think 80 odd stocks is completely reasonable for some people's portfolios.
Yeah, as long as you can manage it, no problems. All right, so I hope that answers your questions. Great conversation there. Let's get on to some tickers for the day. We've probably got about 80 tickers to get through, Jace. So I'm just letting you know. We'll start off with DRO. DRO was the first one before.
DRO, okay. It's just volatility here now. It's like I think this is just a hard play. So it's gone. We've gone from below the averages to above. Now it's come back. It's now back below the averages. Like if it was setting up for another upward run, you'd like to see it get back above the averages, then become established above the averages, form like a new base at higher levels, and then start to rally from there. But because it's come all the way back and that's now below the averages, it just looks like maybe this is going to go into a period where it just doesn't do anything exciting for a while. I don't think we're going to get a rerun of this big upward trend anytime soon. This rally's been sold into, and there we are. We're back below the averages. So not a stock I'd want to buy just at the moment. If I was holding it, where do I want to get out? This is quite common price action after a boom bust here. You get the big rally, you get the decline, and then you get the rebound after the initial decline, maybe some consolidation, and then the air continues to slowly come out over a period of time. So don't discount that possibility here. We've had the big decline, had the rebound, maybe there's a ranging period, then maybe the air comes out over a period of time. may not happen like that at all, but that's the sort of thing that could happen. So that's why I probably wouldn't want to just be like, a buy and hold in this stock, because there's a scenario where there's a lengthy period of air coming out. So not one for me at the moment. And if I was in there, I'd want to have a point where I say, look, it's just not performing. Maybe it's down around $2.50. Look, if it gets to 250, it's back below the averages. There's no momentum. Maybe I'll jump out and do something else for a while. Keep an eye on it. But yeah, that's how I'd see this situation at the moment.
All right, fantastic. Question from OBM. Question from AP around OBM. Hit its stop at 108 and has climbed back to 124 as I write. How do you treat stocks? Do you sell automatically or do you give a stock a chance to get off the naughty list?
Yeah. Sometimes I give them a chance if there's almost an immediate rebound. So if like the stocks has hit the stop during the day and has rebounded and closed on its highs and rallied the next day, depending on the situation, I might give it a little bit of more time, or I could also wait for a bit of a rebound towards the moving averages and sell. I'd be a little bit wary with gold stocks at the moment, because we've had that big decline, we've had the rebound, but is that enough to sort of correct 2 years of extraordinary advance? It's possible that gold goes through a longer consolidation period. So maybe this is like, it's rebounding towards the averages, but then it stalls and some more selling comes in. There could be more selling to come. So I wouldn't be rushing to be building back a gold portfolio at the moment. With stops, sometimes they trigger and that's the low. Sometimes they trigger, they get a rebound, and then they retest the lows. You can never be sure how these things are going to play out as time goes on. But I think overall, having the exit strategy and following it pretty well, like you can play around the edges a bit with stocks like these that rebound, but I think staying pretty true to your exit strategy is the best way, ultimately the best way forward. If we have an exit strategy, we say, look, I like this one, I'll give it a bit more room. Next thing we're holding stocks which are down at a lot lower. So got to be a little bit careful with giving stocks extra time.
Okay. All right. Thank you. Hi, Roberto. Let's have a look at MEI, please.
Yeah, it's holding its averages. It's trying to rally. I think it's a gold-orientated stock as well. It's kind of range-bound at the moment. We've got the October high, the November low, and the price is now moving between those two extremes. I think it's in a holding pattern until we get a break one way or the other. I like that it's like holding its moving average at this point. If it can establish above the moving averages, maybe it sets up the situation where it rallies. It's a small, more explorer-orientated company, as I understand. So it might do something a little bit different to a more established miner, like we just looked at a moment ago. But if I was holding this stock at the moment, I'd continue holding it. I probably wouldn't be in a hurry to buy it. I'd like to see it, just become established above those moving averages and start to move higher before considering it.
Okay, fantastic. Trade Invest MGT. I think we've sort of spoken a lot about the direction and our point of view around that, or Jason's point of view. So, we will get onto your ticket. I don't know if it's, I've never heard of it, but let's obviously LIAM. Let's have a look if we can find something in that. LIAM, Liam. Unless that's your name. Sorry.
So what am I trying wrong?
LIAM. That's it. Now, M for Mary. Sorry, M for Mary. Maybe I'm just getting confused.
I reckon Liam's trying to talk to us.
Maybe. Yeah, might be his name. But what's that one on CBOE? Let's have a quick look. Is that something that
inflation protected longevity income? I
don't.
don't.
You can clarify for us, Liam, if that's your name. Hello. Let's get on to moving averages across flying. There's nothing there. Betty LDX. Sorry, if you've got a ticker for us to analyse, just I can't see it there. Oh, there is one there. MAU. We'll have a look at that one soon. All right, we'll start with
Um,
LDX.
LDX, like it could be going into a ranging period again. So like using the January high, the January low, are we going to get a period of price action just between the two where a range develops? It's like it's been a big run and it's been a sharp fall. I think that tends to often lead to periods where it's then got to stabilise and forms a range. And I don't think it's heading to new highs in the near term. Of course, I could be wrong, and I often am, but I think the sharpness of this fall just severs the upward momentum, and I think that probably takes a little bit more time before they can re-establish. So that's why I think maybe a period of just oscillation outside of the averages could be the play at the moment. If I was holding some, yeah, look, I could continue holding it. I'd want to know where my exit was. It'd probably be below the January low at this point. Like if it can hold above there and trade sideways for a bit, maybe it breaks higher. But I wouldn't be rushing to buy it at the moment. I think we could wait and just see how this develops.
All right, thank you. Let's look at Poet. POET on the Nasdaq.
Yeah. Again, like it's a ranging situation. You can see the recent high and low, and the price action is in between. So not one to buy at the moment. It's below the moving averages, but that could be just part of the movement within a range. If it can get itself back above the averages in the near term, that would be encouraging. Um, if I was holding it, from like depends where we're holding from. There hasn't really been a great trend in this stock. It's been, it's slowly been, it's been making its way higher, but it's been pretty messy on the way up. But if we happen to be in from good levels, uh, yeah, look, maybe there's an exit point below the November low. If it holds there, maybe it's a case of holding it, see whether it just like it's a period of sideways, and then from there it could resolve to the upside. So you can see a pathway higher for it, but it's not showing any momentum at the moment. It's showing just crisscrossing either side of the moving averages. So not in a hurry to buy it. Could hold it, but I'd want to know where my exit was.
All right, thank you. AR1 from Steph. Hi, Steph.
AR1. Yeah, so it looks like this fall is due to an announcement from the company. So it looks like it's like it's not like a capital return or something. Like I just press this adjust button and adjust for dividends that may have been paid. So it looks like that was just a nasty fall. That's a it's not one I'd want to be in at this point. Because we've got this strong rebound, but it's from below the moving averages, so I'm typically not looking at them below the moving averages. I guess on the positive side, we could say like the rally has been strong and the pullback so far has been shallow. So maybe there's some sort of a turnaround happening. If I was holding it, I could probably keep holding it. I'd have a stop down around, I don't know, 7 cents or thereabouts. So if it gets back below the moving averages and keeps going for a bit, maybe it's a case of like, look, okay, something's caused it to rally, but the follow through buying's not happening and now it's being sold into. Maybe I want to just get out. But if it can hold around these averages and start to move higher, well then, look, it could continue recovering. So it's not a standout for me at the moment. Moving averages still need to cross. That's going to take a while. It needs to get a bit higher for that to happen. So it's one I'd stay away from. But there's that strategy which I just discussed about if I was currently holding it.
All right, fantastic. Now we're on to Jen's. MAU, please.
Yeah, look, it's holding up well. I think this is a gold orientated stock. So the moving averages have crossed higher. It's establishing itself above the moving averages after this pullback phase. It's lacked a consistent trend in the last 18 months or so. But maybe this is the consolidation it's working through. Then ultimately it moves higher. It's had a lot of volatility in gold, and this stock's held together quite well. If we just continue to go sideways, maybe we can start to see that price action evolve. So look, I'd be happy to continue to hold this one. Probably not a buyer just yet. Maybe there's a bit more consolidation while the moving averages start to catch up. And an exit point could be just back down around maybe around $1.20, just below this low from January, below the January low. Maybe that's an exit point. So yeah, interesting one to continue holding, I think.
All right, thank you. Soundhound from Chief. It's on the US market. Soundhound. There you go. I'm curious to know what they do. Soundhound.
Oh, there we go. Not at the moment, this one. It's making new lows below declining moving averages. So it's not the sort of situation I'd want to be holding in. And it's like when the structure flips that I want to start looking at an exit. So above rising moving averages, great. Below the moving averages is a warning. Moving averages start to turn, and it's when we get that consolidation below declining moving averages and they cross, and then you get the secondary breakdown where it says, okay, this structure is now turned, and that remains the case. Like I don't want to try and pick a low. Like that could be the low, and maybe it makes its way back up, but it could also just rally back towards the averages. Chop around, sell the rally, and goes make a new low. So that's the risk, and the risk is what keeps me out at this point. It'd be to get interested again. It's got to do quite a bit. It's got to get back above the moving averages and so on. I think that would probably take a bit of time. So yeah, not for now. I don't think.
All right, thank you. One from Jefferson. ARL.
And also I don't know where things are now. Maybe it's where things were in April, and it is the low, and it does start to make its way up, but we just can't know that for sure. That's why I wait for the structure to change before I start looking at it again. And at this point, the risk is, as I say, it's sell the rally and new lows. Sorry, Rog, what was that?
ARL.
Yeah, structure's nice. Recently made new highs, rising moving averages. One I'd want to be hanging on to if I had it. It's like, just looking at it from a longer term perspective. Like, is this a big basing phase which it's been through since 2023, and it's now starting to a series of rising lows. We've got rising highs. It's a sort of stock which we could see continue to move higher over the months ahead. One I'd want to hold on to if I had it. We could use a calculated ATR stop, or just looking at it roughly. I'd be giving it to at least down to probably like 50 cents sort of thing. Lots of room to move around. Because you can see you can get these pullbacks to and below the moving averages. So if you're just using the 100-day moving average plus a little bit, you can get stopped out, and then the thing reverses. So I'd be using a calculated ATR stop, giving it plenty of room. It could be considered as buy, I guess, here as well. I like this last little rally off the moving averages. Looks to be coming out of a consolidation. Maybe a 20% stop thereabouts. If we like this, I guess it could be bought at current levels, 20% stop, and see what happens. So it's an interesting one to keep an eye on.
All right, good one. The next one's from Yuking. PLS, please.
Nice trend pulling back towards the averages. So for me, this would be a hold. I've got LTR in my portfolio, which is similar price action. Pull back to the moving averages. So that's fine. Plenty of room to move. See whether it finds support around the averages. Maybe there's a multi-month consolidation because it has been a big run off the low from $1 through to $5. It's these stocks, they do consolidate these big advances. You can see on the way up from 2021, your big rally, then you get like, well, there's a decent example there. There's a big rally, and there's a multi-month consolidation, January through to May. You can get these 5-6 month consolidations where you get the pullback to the average and it just chops around for a while. The key will it be relatively shallow, and does it start to give those signs that dips are being bought? That's when that's a good sign. I like it when we get the strong rally and the pullback just starts to find support. Will that happen this time around? Well, let's wait and see. If we get that sort of sideways price action over a few months, it could set the stage for another rally. So, one I'd want to hold in terms of buying a new position. I'd like to just let that price action develop a little bit and then consider it.
All right, thank you. Next one's from Link. NMR seems like another junior gold miner, according to them. And N for Nelly, M for Mary, and R.
Right. Okay. Oh, look, a little bit early. It's a nice rally off the bottom, but I want to see it hold on to those gains. Sometimes we see these quick rallies and they're sold into, and things are back where they started from. It's encouraging, but also being careful in this low sub 10 cent space, because they are more prone to they'll run and then the rally be sold into and they'll come back. First step here for me, can it establish above the moving averages? Can the moving averages continue to turn higher? Do we get price action like we've saw there in March, for instance, where do you get that sideways price action? Then from there, do you get a break higher? So if we get that sideways price action and then we start to see a break higher, that's where I'd consider an entry. If I was already in it, great. I'd stay in it. I could have a stop. This is the tricky part with these low price stocks. Like, an appropriate stop is 43% away, and 43% is probably not appropriate. But I say appropriate in terms of like how it looks on a chart. I'd want to give it that sort of move, that sort of size move. But with a sub 10 cent stock, that leads to a large percentage. So that's why it's so difficult. I'd rather see it establish some sort of base, a breakout, and then I could have a relatively closer stop. That's how I'd get into a stock like this. If I happen to buy something at the low, great, I can keep that, have a stop, way down where I looked at before. But otherwise, it's probably for me one to watch at the moment rather than to race in and buy.
Okay, thank you. The next one is from Caroline. AYA, please.
Again, it's that pullback scenario. Like a lot of these mining orientated stocks are going to look like this. That's a 41% pullback. That's probably getting pretty close to most wide trailing stops. I'd probably say with this one, like assuming we're in at a low level, so you can see when the averages cross, and we had some nice entry points down just above a dollar in August last year. So if we're in for that sort of level, probably could give it down to around, let's actually put an ATR stop on it rather than me just guessing it at numbers. So if we're in down here, the way an ATR stop calculates, it's down. At least the trading view ATR stop, which I've set to 10. which is what I use at Motion Trader, but the Motion Trader calculation is a little bit different. So yeah, a wide stop could be down to 2. It could be giving it that much room to move. And people say, well, that's a big percentage. But when the trading ranges are wide, that's just how the calculation works. And remember, look, this was a stock which was, look at these trading ranges down here when it started. The trading ranges were about 1 cent. Now, in a day we're getting moves of 50 cents. So the ranges have been wide. So the trailing stop is wide. I'd be giving at least to probably 250, 2 to 250 for an exit point. I don't want to buy this dip at the moment. I want to see the dip start to find buying interest, and whether it be a range or some sort of consolidation, have to assess that if and when we see that. But it's like, for me, it's holding it. It's not buying it. It's knowing where my exit point is. Maybe it's down in this 250 to 2 region if it continues to pull back, and if I'm in down at really good levels.
All right, thank you. One from Deep. Let's have a look at DRE, please.
Yeah, it just keeps sliding. It's again, this is the thing with these low-priced stocks. They start to get nice structure, but they often don't kick on to large trends. Sometimes they do. This is why we've got to give them, and we don't know which ones will kick onto those big trends. That's why it kind of requires you to give them plenty of room to move. But the cost of that is that a lot of them will come back and take that room to move and then trigger your exit. But I think that's the best way to increase your odds of staying on one of those ones that really do run a long way. With this one, it's now getting a series of lower lows. I think another low below February or below last week's low, it'd be enough for me to say, look, the moving averages are now crossing the downside. It's spending time below the moving averages. It's making new lows. Even if I got in a good level, it just keeps giving back those gains. Where's enough? I'd be looking at an exit pretty soon. Wouldn't be buying it. To consider buying it's got to be back above the moving averages. It's one I'd be letting go soon. It really needs to get its footing here and now, get back above the averages. I think to keep its upside potential in play for now. The risk is it just continues to ebb lower, and in 6 months it's back where it started from, and that is the way it works out for a lot of these sub 10-cent stocks.
Okay, thank you. One from Hubert. Let's have a look at BGL.
Holding up well, considering what's been going on in gold. I'd continue holding it if it was in my portfolio. I'm not in a hurry to buy it. I don't think there's a hurry to buy gold stocks at the moment. But look, if I'm in from there could have been a buy for this. It hasn't been a huge trend by any stretch. This is probably not one which is going to be in a large profit for most people. But look, I could continue to hold it. It's not giving any sign to say, look, this trend is no longer working. Stop would be back down around $1.30. So I'd probably like a sort of stop which would give back most of the gains, considering an entry would probably be down around that $1.30 sort of mark, perhaps. And that'll be the case for a lot of stocks that we buy. That a lot of them, small gains, small losses, neither here nor there, and that's okay. We just let them. They're just like footnotes in our portfolio over time, and we just keep looking for the big ones which extend. This could still turn into one of those ones, but I think we've got to give it enough room that probably gives back most of its gains should it come back. Unless, of course, we just say, look, I want to close down some gold exposure with this rebound, and this has been one of the weaker of the gold stocks. But look, that's another conversation about gold exposure. I won't get into all that now. I've done a lot of that in the my Friday strategy session. So just in short, look, trend remains up. let's have a wide exit stop, I think, and see whether it can stabilise at the averages and continue higher. It's encouraging that it's done well throughout this gold pullback so far.
All right, thank you. Next one's from Neil. Let's have a look at ASB, please.
It's hasn't severed the upward trend. I'd still say this is broadly within a. I'd still say this is within a broad upward trend, which is going through a correction. Like at the moment, this is a big range. Like you can see, it's a big corrective range. It's now below the averages, which are turning lower. So it really does need to get a foothold. I don't want to spend too much time below the averages. Kind of needs to get itself back to the upper end of the range to disengage that window of vulnerability that occurs when prices I don't really want to see this sort of situation where it starts to consolidate below and the averages start to turn, because that's when we could see the break to the downside. But that price action hasn't happened yet. That's the sort of thing I'll look out for. But at the moment, this is a big range. I'd probably be running a trailing stop. Well, it's a motion trader stock, so there's going to be a calculated level for it, which I don't know where it is offhand. But yeah, probably somewhere between 5 and probably maybe it's around that 5 sort of mark. It's probably getting close, but there's still probably a bit of margin in it, and that's why it's wide. So to potentially see off large consolidations, which can still resolve to the upside, it's still got that potential, but it really does need to hold the line where it is now and get back above those averages.
All right, thank you. One from Elisa. ANZ, please.
Yeah, firstly, the upward trend remains in place. ANZ's held above its 100-day moving average, since back down here in June last year. So the trend remains in place. It's I could see it's below its previous high, so it's possible that there's more of a range coming, and that it could come back down and spend some more time ranging before breaking higher. That's a possibility. But it could also be a case where it's just like we're seeing this series of higher highs and higher lows. It could be a case where it just quickly starts to pop higher. I don't know which way it goes. It's like this is a thing when things are within. We've got a high, we've got a low, and we're trading in between the two. Ranges are tricky because you don't know which way or when they're going to break. But if this was in my portfolio, it'd be a case of this is why I use those wide trailing stops. So I don't need to predict which way it's going to break. I can just say, well, I don't know, so I can have my wide stop, which is below the recent low. And if it spends several more months chopping within a range, that's fine. I'll sit there and get paid a dividend. If it breaks higher, great. Again, that's fine. But if it does start to break down and reverse, which is not showing those signs of at the moment, I have a clear-cut exit level. So it's about giving stocks plenty of room to move and let them move around as they will, and try and stay on what could be a larger ongoing upward trend. That's what I'd be doing with ANZ.
All right, thank you. One from Stephanie. It is BHP, please.
Upward trend, nice upward trend. Look at the moving averages, look at the price in relation, and it's all moving in the right direction. We can press this up a bit. BHP's been at new all-time highs. At least I think that's all-time highs. I'll just quickly put that on so all-time highs. Possibility of near-term consolidation because it has had a good run since November. And this is what we were talking about with the materials index a bit earlier. Maybe we do get that consolidation over the next few weeks. Let the moving averages catch up. But I think the odds favour new highs in the months ahead. That's the direction of this trend at the moment. Nothing here suggests that this is topping. Now, of course, tops can form and things can change, but that's not what we have at the moment. So I want to go with what's been working, and what's been working is owning these resource-orientated companies like BHP. For me, this is one I'd want to stay in and look for opportunities maybe to actually get in. But I think near-term consolidation would be probably the favoured view.
All right, thank you. One from Dennis, MM8.
Again, consolidation. There's our high, there's our low, and we're somewhere in between. I like that it's holding the moving average recently. Does it need to do some more sideways, and then could it break higher? I think that's entirely possible. I'd just be holding it. This stock was in my portfolio, I'd be holding it. Wide trailing stop, probably back down at maybe 30 cents or something like that. So giving it lots of room to move. That's assuming I was able to get in early in one of these early sort of like entry signals back down around 10 cents or so. If I bought it at the highs, well, maybe my exit strategy is a little bit different. But assuming a good entry at lower levels, giving it lots of room to move, trailing stop maybe around that 30 mark, and see whether this continues to consolidate and then maybe break to new highs. Look, and I said before, a lot of those sub 10-cent stocks don't kick on, but some of them do. This is an example of one which has. It's had nice structure. It's continued to rise. It's like, and this is why I want to have many relatively small trades, because I don't know which trends are going to be the big ones, and sort of the more players I have on the field, I think the greater the odds of getting in one like Medallion, which really runs. And the ones that don't run, I can shut them down reasonably early, and then keep the good ones while they're working.
All right, thank you. The next one is MYG, please. From Wish. There we go.
Trend still in place. Pull back to the averages. It's a common theme that we're seeing today. It's for me. This would be a hold. It's a motion trader stock. It's a wide trailing stop. It's had nice price action really all the way up. It's been interesting to note. Like you can see how patchy the price action is back in 23, 24. So it's a thinly traded stock, and you can see the price bars are now more established. So as the trends extended, the stock has attracted a wider following. The volume has increased in the stock, and I often see this with some of these emerging companies. They start off thinly traded, and by the end of a large trend, they're quite actively traded. But look, at this point with this stock, I think it's a hold with a wide stop. It's not a buy. Need to see how the consolidation develops. But always have the exit strategy in case that's it. But at the moment, benefit of the doubt, try and stay on it.
All right, thank you. Hi, Sydney. Let's have a look at WCE.
Yeah, holding in quite well for a stock with silver in the title. Look, if I had this, I could continue holding it. My views on silver, I don't think we're going to see silver at new all-time highs anytime soon. I think a larger corrective phase is now underway, and things are possible in like the more medium term, but in the shorter term, like the next few months, I don't see new highs in silver. So if this is, as the name suggests, a silver orientated stock, like discoveries and things, they can mean stocks can do their own thing. I guess if I had this one, I could continue holding it. Look, exit point might be down around 16 cents. Like it had a strong rally. It has it's held on some of it, but it's given back a lot of it. It's rebounded today with silver rebounding. I don't think this is a standout for me at the moment. If I had it, I'd want to think about, okay, where am I going to cut this? I don't want to like have a stock which I just put in the bottom drawer and then look at it next year and it's down to 6 cents. So I want to have an exit strategy if it can't kick onto new highs. Not one I'd be looking to buy at the moment. Maybe it's a hold, but I think have an exit strategy somewhere maybe around 16, 14 cents perhaps.
Okay, thank you. Talwin, hello. RDX, please.
Developing trend. It's back above the averages. Averages have crossed. We've had a couple of shallow. Well, we've had a couple of consolidations. The latest pullbacks have been fairly shallow. The key is, can it hold this recent low, just stabilize above the moving averages and pop to a new high? I'd want to stay on this one if I was on board. It's one I'd start thinking about. Look, would I want to buy a stake? I wonder whether this is a motion trader stock. It's probably a motion trader stock, just looking at the price action. It's just with a little bit of uncertainty in markets, I'd probably wouldn't, if markets were trending nicely, I'd probably say, look, this could be a buy the dip. But with just as I said in the indices section, I said the waters are a little bit muddied. I'd probably resist trying to buy the dip at the moment. But if it can stabilize here, then start to break higher, look, it's probably a go with that and buy that momentum should it develop. But Rog, one I'd be happy to hold on to.
All right, good one. Hi, Albert. TVN. V for Valerie, sorry. TV for Valerie.
Oh, well, this one continues to charge. It's keep on working. It's like if I'm in this one, I'm holding, and it's such a nice breakout too. And just looking this structure it gave us, look at the classic compression structure. It's structures really do help when you look at charts, when you get them. Strong rally, multi-month sideways compression range, clear break to the upside. So you can buy, if you're watching this stock, you can buy the breakout, have a stop back in the range, and if they run, let them run. And this one has run. So I'd be continue to do what's been working. That is let it run. It is up a lot from the breakout point. It's up to 55%. Look, I'd continue letting it run. Moving averages are catching up. At some point, I might consider scaling out of a little bit of it, sell a quarter, sell a third or something. But I'd be keeping my bulk position and wide trailing stop, see where it goes. Not one I'd want to buy at the moment because I think it's too hard to put an initial stop loss on, which feels like it's going to be effective. But it's a nice trend to let extend and see where it goes.
All right, thank you. Hi, Jane. Let's have a look at ETPMAG.
Oh, that's silver. It's an ASX listed silver ETF, which I've got some of myself. Okay, this one here. I've talked a lot about this in the Friday strategy sessions. So this is how I've played it. I think I bought it around somewhere around here, June, July last year. I sold a third here on the 29th of December, and I sold a bit more here at the just before on the Friday, just before the last move up. So it must have been here. So that took me down to half my position. So I missed the high by a week, and that's fine. I never expect to get the high, but I was scaling out of what was becoming a vertical rally. This fall created plenty of volatility in my portfolio, but a lot less volatility than I'd continue to hold the full position in a vertical run-up. Looking at it now, I spoke at length about this in the Friday strategy session, so I won't go through it all now. There's a whole lot of stuff I went through. I just think this rally is over for now. I think once the FOMO cycle is broken, like people buying, they see prices rise, they buy again, they've missed out and they chase it. Once that FOMO cycle is broken with the downdraft, it takes a lot to respark it. And I suspect silver's in for like a lengthy consolidation now. I'm happy to hold a core position medium to longer term, but I lightened up my holdings for this very possibility that we do go through a lengthy consolidation. Not one I'd be buying at the moment. If I had too much and I was uncomfortable with what's happened, particularly if I was in at lower levels, I could still think about closing some out now. Like silver's back currently trading where it was on the 29th of December when I sold the first portion of my portfolio. So maybe we missed that final bit, but even like this is for anyone who's like sat through this and now is relief that there's been a rebound, going, oh, I couldn't go through couldn't go through that again, and the possibility of it coming down to 70 is just unimaginable. Maybe this rebound is the second chance to just lighten. Despite maybe it's not at the high, but it's still at levels which a month and a half ago were considered amazing at the time. So it's I think care be taken in silver at this point in time.
Yeah, it's a big drop on that ETF, that's for sure. So we'll finish off on one last one, which seems to be another ETF, and it's fuel. So from H Perth.
That's nice. It's a nice breakout in this ETF. I like look at the moving averages, and you've got that constant series of rising lows, rising highs, and now we've got the acceleration from mid-January. I'd be happy to hold this one. It's one worth looking for an entry opportunity. If we get a little sideways consolidation, similar to what we saw in mid-January, something like that. But just at the moving averages catch up a bit, that could create an entry point. Interesting developments happening in the oil price as well. It's also breaking out above these. You can see this run of previous highs, which is now above. So I think this could be a good sort of like maybe it's shaping up as a good medium-term hold. Also interesting, I note here that it's hedged. And I think this is important because it like the Aussie dollar is looking like it's going into a new upward phase, which it hasn't been in for some time. So that means that if you're holding US shares, for instance, and the Aussie dollar is rising, that's going to be a headwind for your performance. So and again, I was talking about this in the Friday strategy session, considering if this is going to be an upward phase in the Aussie dollar, if this continues to develop and extend, investments in the US might be better off being hedged. So like there's an S&P 500 ETF, which is like hedged back into Aussie dollars. So it takes out the currency exposure. This Better Shares ETF, it's hedged. So if the Aussie dollar continues to strengthen, you're not adversely impacted by that. If it's unhedged and the Aussie dollar rises, the ETF might be up 10% in US dollar terms, but when you convert it back to Aussie, it's actually flat. And you go, well, that's a bit disappointing. I'm in an ETF which has gone up, but converted back into Aussie dollar, I made no money. So I think it's worth considering. Do I want to have a hedged ETF at this point? And I think the Aussie dollar is giving signs that there may be higher levels to come.
Yeah, it's a great point you bring up, Jason. Actually, I'm noticing that in my US portfolio with my individual stocks as well. So, but let's finish up on that note. And if you haven't, sorry if I've missed any of your tickers, but if you haven't heard, Jason's mentioned his Friday strategy session a few times now. So feel free to jump over to that over at motiontrader.com.au, and you can sign up to the trial there as well.
Hey, Rog, just one quick thing. I just quickly show viewers the difference currency can make. So there's the S&P 500 in US dollar terms. Now let's price it in Aussie, and watch the difference this makes. There you go. So let's just do it I'll get it here as well, so I can just flick between them. It's like a magic trick. There you go. Look at our gains. Let them go.
Eroded by the strength of the Aussie dollar. Yep.
So don't overlook currency risk. It's the Aussie dollar's been weakening for a number of years overall. So it hasn't been anything that people have had to think about, because it's added to performance. But when it goes the other way, it detracts from performance. So it turns the S&P 500. Like if we were talking about structure, this is not great structure. It's consolidating below moving averages, which are reversing. But that's not what your American investors seeing. They're looking at that. It's above rising moving averages. Currency makes a difference, so take that into mind.
Yeah, currency risk is a real thing. And on that note, we will end there. Thanks, Jason. Thanks for another great show of learning and discussion. Really appreciate it. Thank you, everyone on the other side of the line, for giving us all your stock codes. Sorry we can't get through them all, but we've gone well over time once again, Jay, so thank you.
Yeah, look, that's been fun. It was good going through a whole lot of stuff today, because there was a lot to talk about, and hopefully that's been helpful and interesting. And next week, Rog, we can have another go at it.
Yeah, we've got an interesting question around liquidity, which I might bring up next week. So thanks, everyone, and we'll see you again at the same time